morning. Welcome to the International Insurance Society's Experts Webinar Series. I'm Josh Landau, the president of the IIS, and today we are excited to present a discussion on one of the most important and timely subjects. Climate change and other rapidly accelerating environmental and social issues present enormous challenges and opportunities for the insurance industry. This webinar will probe some of the most important ESG issues from the perspective of intermediaries and carriers, hosted by our ESG expert, Bill Marcoux, along with special guests Amy Barnes, Managing Director at Marsh, and Kelly Hareed, Director of Catastrophe R&D at Liberty Mutual. Please also be sure to join us at our annual Global Insurance Forum, a 3-day virtual event on September 27th, 28th, and 29th, with global leaders leading discussions on the critical topics impacting our industry. This free event can be found on our website, internationalinsurance.org. Now, I'm pleased to introduce Bill Marcoux, an advisor to senior insurance executives, board members, and other insurance industry stakeholders. He has 40 years of experience working in the insurance sector, most recently as the global head of DLA Piper's corporate insurance practice, and previously as co-head of the insurance sector practice at Dewey & LaBeouf. Bill is a chair of the Insurance Development Forum's Working Group on Law, Regulation, and Resilience Policies, and is a member of the IDF Operations Committee. He also serves on the advisory committee to the Dean of the Michigan Law School and is on the Executive Council here at the IIS. Please join me in welcoming Bill Marcoux.
Josh, thanks very much for that introduction. If we were doing this conversation even 18 months ago, I think we'd probably start with defining what ESG is. We don't have to do that today. Everybody in the industry is very much alive to the issues that we're going to discuss over the next 45 minutes or so. There is probably no more pressing issue facing the insurance industry. I think there's huge challenges, but there's significant opportunities around this subject as well. But through the last year, accelerated by COVID, accelerated by social justice related issues, clearly accelerated by just the undeniable frequency and severity of climate related events. Everyone within the insurance industry, within the global economy generally, are talking about environmental, social, and governance related issues. We're going to spend today trying to really dive into some of the really critical, difficult issues that are presented to the insurance industry around this topic. Everybody knows the issues of, there's value, there's necessity, but when you start to unpack these issues and start to dive into them, I think we will all see and need to know that they're complicated, they're nuanced. There's trade-offs, there's tough decisions that need to be made. There's some low-hanging fruit, but there's a lot of high-hanging fruit. And we're just going to try to touch on some of those, illuminate them, and hopefully stimulate some thought around these topics. That's a daunting ask for any panel, but we're really fortunate today to have two people who are heavily involved in this topic for two of the major players in the insurance sector. Amy Barnes is Head of Sustainability and Climate Change Strategy at Marsh McLennan. And Kelly Hareed is Director of Catastrophe Research and Development at Liberty Mutual, but also, very importantly, just part of the core team at Liberty that is working on a broad range of sustainability and resilience related issues. Interestingly, we're going to get into this. Both Kelly and Amy really have we call it scientific, data-driven, backgrounds. They approach this from an interesting perspective, and we're going to talk a bit about that. The other point, and you can actually look at their bios online here and see more of their impressive careers, but we're really fortunate to have them both here. One other reference point as we dive into this, the IAS did publish a paper that I wrote a few months ago on the ESG issues, the regulatory developments, sort of the goals and limitations surrounding that. We're going to touch upon that in this conversation. It's going to be much broader, but clearly what's happening from the regulators across the globe is very, very relevant here. But you may find that short paper, of some interest there. Kelly and Amy, let's jump into this right now. And I guess take a few moments though and tell us about your background, how you got engaged with ESG related issues. And I think by that probably also illuminate a little bit more what you're doing for both of your companies. So maybe Amy, start with you, and then Kelly, ask you to fill in as well. Thanks.
Thanks, Bill. So I had a fairly sort of circuitous route into the environmental science part, and then especially into sustainability and climate change. So after a number of career forays, I found myself in Azerbaijan working on an asbestos landfill site for BP, and really enjoyed the work. And so decided to go back to university, and I took a master's in contaminated land management. And from there started working with governments, advising them on environmental policy. I eventually ended up in the insurance industry, not even knowing how to spell insurance, but as an environmental insurance broker, and had a number of different positions before finding myself in the energy practice back in 2008. And I was fascinated by the energy practice because it's so prescient, it's always relevant, it's key to economic success, it's key to so many nation states, it's relevant for every single industry, but at the same time, even back in 2008, there were some really pressing environmental issues, thinking about decommissioning, thinking about decarbonisation. So worked there leading a number of energy, power and renewables groups until April of this year. I was asked to take over the leadership of our climate and sustainability team. It had been an area that I'm passionate about, and looking after the energy business, it was an area that we've been focused on advising clients for really quite some time as they were thinking about their own messaging to insurers, how insurers were treating them, and also how they contemplated the people that they partnered with. So to then just pivot into sort of what my responsibilities are now, I'm responsible for how we serve clients around all things climate and sustainability. Now, how Marsh manages itself is of critical importance because we don't have credibility unless we're proud of the stance that we take. And I'm really proud of the organisation and the commitments that we've made, not just around environmental and getting to net zero, but also around social justice, equality and the quality of our governance. But my role is thinking about how we serve clients and prospects. And I think there are two areas, and I think we're really going to talk a lot about the insurance side here, because the way we talk to our clients about insurance, their relationship with insurance is changing. Insurers are becoming far more inquisitive about clients' ESG and climate credentials, but equally the insureds are more curious about the insurers. The products are evolving and changing, and we need to innovate new products. We also need to be seeking new ESG aligned capital, of that surplus ESG capital that can create a better price advantage, supply demand, if we attract that risk capital in for our best ESG risk. We also have a really large advisory part of the business, and that's because there's a huge amount of this is risk management. And as we understand and collect more data around how people manage their sustainability, we have much better insight into the relationships between ESG quality and underwriting experience. So a lot of work there. And then finally, the area that Marsh is expert in, I am not, and Kelly most definitely is the climate change modelling, which is critical to as input into designing any of those solutions. So thank you, Bill.
Very good, Amy. It is a fascinating background. It gives you a unique perspective and set of skills on this issue, and we're gonna probe those in a bit here. Kelly, give us your quick history and how you arrived in the position you are right now in dealing with ESG issues.
Thanks, and I appreciate you having me here today. My background is also a little bit of an accidental stumble into the insurance industry. I feel like that's pretty common across our field, especially as you get into the wilder and woollier parts of climate and catastrophe modeling. My background is in geology, and I have a PhD in climate science. As I was nearing the end of my degree and I was thinking through where I was going to land, I happened to completely accidentally be recruited into the reinsurance side of the business. I had to go look up what reinsurance actually was. and spent about 5 years there trying to wrestle the biggest, meanest, ugliest disasters that the insurance sector has to deal with. I've been on the primary side of the insurance industry for a number of years, the entire time working in the catastrophe modeling space, really thinking about our management of, again, big, ugly disasters. But, you know, it's really changed. There's been a sea change in the last couple of years where suddenly my background in climate science has been really coming to the forefront. I found that suddenly all of this knowledge and background that I'd been using to some extent for a number of years has really just gained an enormous amount of attention in response to the changing regulatory environment, a rapidly changing risk environment. I think that the pressing needs of managing climate risk from a catastrophe standpoint have really come to the fore in the industry in the last couple of years. And so it's really an exciting place to be. So nowadays I sit on the Liberty Mutual Catastrophe Research and Development team. I sit in our enterprise risk management group. So I try to think about how to manage both our insured portfolios, think through incorporating disaster and climate risk into the strategy of our individual business units. I also work really closely with our Office of Sustainability to think through sort of bigger picture climate and economic risk across the organization, how to incorporate transition risk and sort of broader strategy beyond just what do losses look like on an insured portfolio. So it's a really exciting space to be in, and I'm happy to be here and chat about it today.
That's great. Listen, 2 quick points. Your resumes and your careers emphasize a big issue that Josh and I have spent a lot of time talking about, and the IAS has as well. It's talent recruitment and maintenance, and how it's changed so profoundly for the insurance industry through technology and other issues. But your backgrounds and how you came, I think, are kind of, you know, the classic example of where the insurance industry, if it's gonna survive, if it's gonna thrive going forward, it's going to, you know, it's doing it, but needs to cast its talent net much broader, and these skill sets, you know, being data scientists, client scientists, being geologists, understanding these backgrounds are so important. The second point I think is important to emphasize, and I think as we talk, maybe the audience will pick up on this, that Amy is really, her role within Marsh, probably natural for an intermediary, is focusing on the Marsh clients who are, you know, corporations, they're entities that are operating that need to understand transition, need insurance tools and resources to help them do that. But I'd kind of put, I know this isn't a clear demarcation, but, you know, Amy being probably more outward looking to society at large and trying to deal with those issues. And Kelly, you looking at the risks that are present for Liberty Mutual. Clearly, your regulators, your policy holders, you know, the rating agencies all want to know that Liberty Mutual is on top of what's happening and has a sustainable business and is addressing these issues. But I think you see Kelly's probably a bit more looking at the organizational part of it, and Amy is here. So as we go forward, just to have people sort of keep those 2 perspectives, I think it's what's very useful here. You know, what I can begin with is sort of data related issues. I mean, everybody, we've touched upon it a lot, and Kelly, probably, you know, for you, can you talk a bit more about what data means around these issues, the good, the bad, the gaps, but talk a bit about how the use of data, how useful it is, and what your views on that is. Be interesting to hear.
Sure. We'll start from sort of the climate perspective, and Amy may want to jump in a little bit more on the broader sort of ESG big picture look. But I'm going to start really with climate, because there are 2 kind of key pieces where we need to understand how to incorporate climate risk into our risk management as an organization, both for ourselves and for our clients. So from the science standpoint, much of the question on data comes from how climate change will impact our major hazards that we care about, things like hurricanes, wildfires, floods. We're really very focused on the extremes that drive the year-to-year impacts on our business. The problem, of course, is that coming from the climate modeling perspective, climate models are really designed to do particular things very well. They're very good at looking at sort of broad scale patterns of changes in average conditions over large spatial scales at long periods of time. If you want to know sort of what average temperatures could look like going out 50 and 100 years into the future, a climate tool is a great tool to use. The problem is, what do you need as a risk modeler? You need risk information at the scale of individual locations of your individual insureds, down to the building level, ideally. You need to know that information on the timescale of your single underwriting years, and maybe looking 5 or 10 years out into the future for sort of portfolio management and strategy. You're not looking at the year 2100. You can't do anything with 2100. And we're really focused on extremes. Like I said, we're talking about hurricanes. We're not talking about 2 degrees C of warming. Now, that's not to say that we can't take decision relevant metrics out of climate models and apply them to the tools that we use to manage these high resolution extremes, which are mainly being handled in catastrophe models. There are some really good examples where there's great information that we can pull out of climate models today and put into our view of risk. Sea level rise is a perfect example of this. In the less than 10 years time frame, we have a good idea of what sea level rise is going to look like. And it turns out with hurricanes, every single storm surge is now a little bit worse because it sits on a slightly higher platform of sea level. We can quantify those climate impacts, we can put those in a model, and we can run those today. So that's where our data needs are being met relatively well. But the changes in the most impactful events to our books, the most intense hurricanes, what's been changing in the wildfire environment, that is really kind of at the bleeding edge of climate science now. And that's where there still are data gaps, and it's because there are science gaps. That's an area of active understanding. Now, I gave a lot of examples sort of from the hazard side, but the thing that makes climate modeling and climate risk management really challenging from an insurer's perspective is that you need to bring a certain level of data yourself to the table. You essentially have to be able to ante up a certain data quality to be able to say anything meaningful about some of our biggest perils, particularly anything related to water, so anything flooding, storm surge, sea level rise, as well as wildfire. Because that type of these incredibly rapidly changing perils are what's known as high resolution perils, which means that they vary a lot on really small spatial scales. If you're running a hurricane model, it doesn't so much matter if your house is mapped in the right place or if it's a mile down the road. Wind risk doesn't vary that much over that spatial scale. But you can have next door neighbors with dramatically different levels of flood risk because one of those houses was elevated on stilts and the other one wasn't. That's the level of granularity that we need to capture. Yeah. So climate risk requires bringing more to the table from a data and analytics standpoint than we've ever had to do before with some of our classical perils like hurricane and earthquake.
If I may,
yeah, please react to that.
So I agree with absolutely everything Kelly has said, with one really big caveat. That only applies to certain parts of the world where we have the data foundation that Kelly referred to. We have that in the US, we have that in a lot of places within Europe, we have it in Australia, but there are large tracts of the world where we don't have a good library of meteorological data. We have really extreme changing climate and weather, and our clients are exposed whether through their own asset footprint or whether through the supply chain, and that's a real challenge. And it's not just that we don't have the legacy, we don't have a good 60-year record. Even as we think about ways to protect people going into the future, we don't even have a good way of measuring weather events to a reasonable spatial resolution currently. So agree completely what Kelly said, but there are some quite large black spots on the planet.
Yep.
And those are contributing to a significant protection gap in many of those areas. It's difficult to write risks if you don't know where your locations are, or if you don't have a good sense of hazard. And it's led to many of those territories being comparatively underinsured, which means they're more exposed to this accelerating climate risk. So that's a critical data gap that we need to fill.
Exactly that.
And I know there's been discussions, and it sounds like there definitely needs to be more about, and how do we start to share these models? I mean, the other issue then is if it's a developed economy, or if it's a group of insured corporations or so, they can pay for models and the like. But then the issue is how do emerging developing economies as well get access to the data? and not have people have to.
But Bill, that's the real challenge. A lot of this isn't money. Money can't buy the data. It hasn't been collected over the past 60 years. So it's just this void, which now we can start to rectify. But if you ask Kelly to model something without a history, it's kind of struggle.
Yeah, kind of impossible. Yeah, kind of impossible. So, well, a big issue in an area where work needs to be done. Significantly, a significant amount of it. Amy, we've been talking around ESG broadly, but climate risk. I'd be interested in, and you made some references to this because indeed Marsh has been absolutely on the forefront of climate change related issues, but absolutely on the forefront of social issues as well. Can you talk just a bit about how the climate risk management component of what is very, very relevant and important that we've started to speak here, how that kind of fits with the ESG agenda more broadly, and maybe just talk a bit about where perhaps laudable goals come into conflict. Just be interested in kind of the really big picture here, but how you see from the work that you do that you've got competing issues and or goals and they're all proper ones. But be interested in your views on that.
Thank you. And I know kind of in the intro you said that everybody knows what ESG is, and I couldn't agree more. But I do think it's worth level setting just how some of the vocabulary fits together, because it is used interchangeably when there is nuance. Sustainability, we're referring to people, planet, and profit, and ESG is a measure of sustainability. And then within the E, we have climate change. So it isn't even all of the E for environment within ESG, looking at how weather-related perils will impact businesses. And when we think about climate risk, we don't just think about the physical risk, we also think about the transition risk. What's the risk to organizations as whole systems change? So we know we need to get to net zero real fast. I don't think anybody is challenging that. But the way that we get there, we do need to discuss for exactly the reasons that you raised, Bill, because I think society has said that we want the transition to be fair and just. And to be fair and just, we need to contemplate what access to energy means, as energy is one of the large contributors to greenhouse gases. So if we want it to be fair and just, and we recognise that access to energy is giving people better health outcomes, better education outcomes, better economic outcomes, we need to give some of those systems time to adjust. So we have seen some instances where there have been really clear mandates around trying to move away from some of the carbon intensive technologies on the turn of a dime, which just doesn't happen. And that denies some of those communities on the S access, or could deny access on the S. And so I think that there is a balance there. I have to say, I'd say the majority of time, the objectives are aligned. Thinking about climate and sustainability, climate change is very aligned with sustainability issues, but it does come into tension at times, and we really need to be very thoughtful. And it's difficult because these issues are complex, they're new, they take multidisciplinary teams collaborating in ways that they haven't in the past. So the tensions aren't frequent, but they do need to be very clearly thought out.
Amy, that's very useful comments surrounding these issues and the demands that your clients in particular have in trying to manage what their industries are going to do to move to a transition, and the key role that the insurance industry has in this in the space of helping them come along.
Phil, that's absolutely right. We're in a really privileged position to help the transition, help create products and opportunities to accelerate the transition by supporting renewables, green energy, by providing the type of insight that Kelly talked about, because we're risk management professionals. We're really good at looking at large sets of data, finding correlations and relationships, helping people improve their risk. We're really good at giving that insight at the project inception to help people to design projects that are better, more robust, more resilient. So couldn't agree more. Insurance has a critical role in the transition and in improving sustainability, because we are part of the financial ecosystem. So I think it's a responsibility that I think I can speak for Kelly that both of our organizations take really seriously.
Kelly, anything to add there from what Liberty is doing with regard to either seeding companies that you reinsure or insureds that you're working with? What's happening with regard to transition?
Well, I'm going to talk a little bit about sort of the interplay between E and S here a little bit, because it kind of ties back to our original question on data. We tend to want to manage risk towards the data that we are collecting. But I think what the broader ESG movement has brought to the fore is that not all of our outcomes are directly economic. So that means, for example, if you're trying to mitigate your risk as a way to, focus on minimizing the cost of climate to the economy, a laudable goal and an important one, we have to make sure that we go into it keeping in mind what we're not measuring, what we don't necessarily have well quantified, where we're chasing after a question because we have a tool that is well suited to look at that risk, when we might be missing something that's going on in the broader picture. So an example here is that one really good way to reduce your, say, flood risk is to build a seawall that protects the wealthiest community in a neighborhood, because those homes have the highest property value. And so, in terms of bang for your buck, that's where you can have the least amount of defenses protecting the most amount of money. I think we can all agree that just protecting wealthy homeowners is not an optimal outcome. We want to make sure that we protect everybody against the coming climate-related changes. But if all we're measuring is economic loss, we might miss that bigger picture of the social impacts of the climate adaptation decisions that we are making in the insurance space every day. Every time we write a policy, we are making a climate adaptation decision. So if we don't have ESG woven into the very fabric of every piece of our business, if you don't think about the broader sort of equity impacts of everything that we do, you can end up with these unintentional sort of counterproductive outcomes where, you don't have a way to figure out how to protect sort of broader communities rather than just optimizing for economic risk. So I think we have to make sure that we don't just chase metrics where we happen to have a tool that's well suited, but we think also about qualitative risk. How can climate change impact our economy, but also how can climate change impact our society? And making sure that we, as the insurance industry, are good partners across all aspects of society and not just saving money.
Well said. Amy, you said something in your introductory comments that I want to come back to right here, which is the need for the industry to really focus on the businesses that they're serving, to be innovative, to evolution of products that are offered, and I believe, whether we're talking about ESG issues or others, that is a real core issue for the insurance industry to come to grips with, is looking at their products, what their customers need, and designing them. But kind of what's your sense? Do you see a lot of innovation, or do you think it's really something that the industry has to seriously redouble its efforts on? So what's your view? Because Marsh has got contacts with everybody who sells insurance products, but do you see what you need, or is there still some real work to be done?
I think it's kind of yes to both. So let me just unpack that for a second. It's just like, historically, we're not great at new product development. We're fairly reactive in our innovation, and it tends to be fairly small scale, and it tends to be in response to a specific client demand. We're not good at broad innovation. And sometimes we have been known as an industry to go away into a cupboard and innovate something and come and deliver it to the clients, and clients say, that's not solving a problem that I have. So we need to avoid that. But I do actually feel more optimistic at the moment, because there are a number of initiatives to try and accelerate innovation. In London, the Sustainable Markets Initiative that's being sponsored by Prince Charles to look at areas that the insurance industry should be innovating in. And one of the things that it's doing is crucial to this. It's trying to challenge and change the way that we work, because we haven't historically collaborated. We compete fiercely, certainly as brokers. And the challenges that we have are going to force us to come together and collaborate in new ways. And when we see that with the Insurer Net Zero Alliance, we see that with the Sustainable Markets Initiative. And interestingly, both the Sustainable Markets Initiative and the Net Zero Alliance, their start point was speaking with our anti-competition lawyers to make sure we don't fall foul of any laws. Entirely appropriate, but we need to kind of get past that mindset so we can shift the agenda forward. So historically, we haven't been good. I'm excited by the initiatives that I've seen and the commitment from Marsh as part of the Sustainable Markets Initiative, as is Aon, as is Willis, as is Gallagher's, as is Howden's, a whole host of brokers, as well as insurers, coming together and really trying hard to change our cultural ways of working, to co-create and identify solutions, all while obviously respecting competition law. So yes, we're doing more than we have done. Yes, we need to do more than we're doing.
Kelly, what from Liberty Mutual's standpoint, what do you see going on in terms of evolution of products? And then of course, you've got the whole risk management component. You start having new products with new exposures and the like, but what's your view of the activity in that area?
So to me, I see climate risk having sort of two big areas where the insurance industry has traditionally not really fallen in. The first is the issue of the protection gap, having perils or hazards that due to market conditions, due to take-up rates, due to whatever reason, are typically not covered particularly well by the insurance industry. So that means that when a disaster happens, homeowners and businesses are left on their own to try and put themselves back together without the backstop and resources of having a good insurance policy. So trying to think of products that can help to fill that protection gap. There's a lot of innovation, for example, in the parametric space is a good place that people have been trying to break through those traditional barriers of there hasn't been a product here. How can we find a product that can help to fill that need? Some of that is coming from better modeling. Flood has historically been a very difficult peril to model. It's one of the fastest changing perils from a climate perspective. So how do we fill that massive flood protection gap in the US? I think that you need to have, it's always been sort of a catch-22 in the US market, that there weren't better flood models because there wasn't a flood market, and there wasn't a flood market because there weren't better flood models. And really in the last couple of years, that impasse has started to break, and which, when you have tools that are available to help you assess risk, that's what can help to drive innovation. So the second big piece, though, that makes climate risk in particular a challenge from an insurance perspective is that insurance is designed to operate on the scale of individuals, whether it's homeowners, whether it's a single company. It's designed to say, I'm going to help this single entity manage its risk to disasters of whatever flavor. So if you're in, say, a flood-prone community and you have an insurance policy that is priced in such a way that it's reflecting the risk of that area, you might decide that it's worth raising your home up on stilts to lower your individual insurance premium. And that would be a logical and economically efficient decision for yourself as an individual. The problem is climate risk may be changing the flood risk for the entire community. It probably doesn't make sense for the entire community to lift itself up on stilts. Maybe that community could instead invest in things like stormwater management, or a new levee, or a new seawall, or some other sort of, or maybe some green infrastructure and protecting its coastal marshes that would be more efficient on a community scale, but that one individual can't do on their own. Insurance has not traditionally had products that are tied to community scale mitigation because we're targeted at individuals. But I think that's an area where there can be a lot of product innovation that is thinking more holistically about risk over broad regions all at once. And I think that's a really active area of ferment in our industry.
It's an interesting point, and there is obviously growing work in the sort of the sovereign and sub-sovereign risk, insuring cities, counties, states, not just homeowners, which obviously provides a spreading of risk. But I think what's also embedded in what Amy was talking about and what you've just touched upon as well, again, this is really one of the values of the insurance industry across many risks, but with regard to climate risk and the issues we've been talking about, is its risk mitigation understanding. I mean, it's what what the insurance industry knows to avoid the loss, not just, okay, we'll be there, to pick up the pieces after the disaster, but it's bringing those skill sets, to bear. I'm mindful of the time, and so there's a huge amount more that we could talk around that. Let me just move for a moment, because this is a overarching big issue around ESG, and it's the legal regulatory requirements, and just to use a climate risk phrase, the tsunami of regulations that are flowing over the industry. Different countries doing different things, sometimes maybe more or less the same, but oftentimes very different, the duplication. Can you just talk a bit, and this is, I did touch upon this a bit in the paper that I referenced, and there are just a lot of voices in this debate, and a lot of jurisdictions that are driving actual legal requirements or regulatory requirements. But I'd like to get both of your views just sort of on how you see this, number one, but within it, what can regulators do that will really help going forward, and where do you see kind of there's really serious challenges, or the places where the regulation might actually get in the way of doing the right thing? But what's your take? Maybe Amy, do you want to start on that, and then Kelly, you can chime in.
So, I mean, most of the regulation to date has been around climate rather than around sustainability. Although I think it was last week in the US, the House of Representatives passed I'm going to have to read from my screen to get the name right. But I can't see it, in the ESG Disclosure Act 2021, which will require sort of clear presentation of the ESG risk. So we're seeing that the regulation is moving from pure climate, where most of it has been focused, into far more broad sustainability. There is a raft of regulation that applies differently in different jurisdictions. I do think that at the meeting in November, COP26, which many of the listeners may be familiar with, I do think we'll see an alignment around regulation. I think a lot of people will align around TCFD reporting, the Task Force for Climate-Related Financial Disclosure. The G7 have already said that that's where they're going to be. And so I would expect to see more along those lines. So there is a raft, it's complex, and it varies by country. But actually, I would say that there almost isn't enough. And the reason I would say that, and it's not necessarily isn't enough regulation, but there isn't enough clarity. We're asking companies to move faster than governments. And so investors are expecting that corporates can set out net zero policies when they're operating in a framework where the government hasn't set out regulations. They're having to make assumptions about what the regulation will be to get to net zero specifically. They're having to make assumptions about the technology. They're having to make assumptions about the price of carbon. And there's this huge amount of uncertainty, yet in their reporting, if they try to keep optionality and reflect the uncertainty, they're penalized by investors, because investors see that that isn't firm enough commitments to get to net zero. So this dichotomy of sort of almost too much and complex regulation, but not enough certainty to allow companies to either to be very transparent in the fact that a lot of companies don't know exactly how they're going to get there. They're making assumptions, and they're maintaining optionality in their plans, depending on which bets pay off. So I actually think that we would do better by corporations if we gave them simplicity for sure, but also more certainty around the regime in which they had to operate.
Understand. Kelly, your thoughts on that?
Yeah, I think that's a really important point. And I think some of this is stemming from the fact that much of the regulatory request that we've seen coming to the insurance sector has essentially been taking what's already happened in the financial sector and trying to say, well, insurers, you respond to it too. But at the end of the day, the kinds of climate-driven risk or ESG-driven risk that you see in the financial sector are not necessarily the same thing as what we see in the insurance sector. Like we were talking about at the beginning, we're very driven by short timeframes and extreme events. That's kind of our bread and butter risk management, and that's the appropriate time frame that we use for making decisions. If I were building a bridge with a 75-year lifetime, I would need to think very carefully about very long-term climate risk. But that's not the part of the economy where the insurance industry typically operates. So we need to make sure that the metrics that we are being asked to produce and the scenarios that we're being asked to produce actually reflect the risk of the insurance industry and are not just sort of banking regulations that are sort of strapped on to the insurance industry. It's more meaningful to actually look at the risk that we experience, because if you make that regulatory body and those regulatory scenarios relevant to your decision makers, if you can put it in terms of metrics that the business uses to make decisions about profitability and about capital allocation, then people can take that data away and actually use it to manage climate risk in business. What we don't want to see happen is to say, run a climate scenario for 50 years in the future. We don't really know how we would get there. We don't really know when it would start to affect our risk appetite. And so you hand it to the business and they say, now what? If we can make sure that out of the regulatory environment, we get the most actionable science that we can put into the ground in our underwriting, in our decision-making today, that is regulation doing what it should be doing.
Well said.
I would
Amy, please.
I would reinforce Kelly's points. Kelly was taking the fact that regulation designed for the banking industry is being put on the insurance community, and even more so, those challenges exist in the real economy. And so are the regulations fit for purpose for our clients as well? And so I still maintain that we need more certainty around our regulations, so then companies can build investment plans that they don't get penalized for by the investors, but simplicity would be good.
Yeah.
And those regulations are not cost-free. You know, it's one thing to say, well, look and see what would happen if you had a 60% increase in hurricane frequency. I'm just going to make something up here. But the problem is, if the science isn't there yet, and I deliberately choose hurricane frequency because there is currently a very hot literature debate right now arguing whether we are going to have not just how many hurricanes, but more or fewer. We don't just not know the direction of change in hurricane frequency or the magnitude. We don't know the direction of change in hurricane frequency. If you don't know whether hurricanes are going to go up or down, how are you supposed to make portfolio steering decisions that are meaningful? Yep. Instead, by starting off where we talked about at the beginning, looking at the subperils where the science is clear at a time frame that's appropriate for our decision making, then we can actually translate what's happening in the climate science space into something that our businesses can use. And that is where, you know, as a climate scientist, I feel like I can bring more to the table for Liberty and for our insured clients.
Listen, those comments on those issues there's a place that we'll have to end our conversation, but it proves the point about how complex these issues are, how fundamentally important they are. I want to thank you both for joining today. Your views, the perspectives both of you is very, very valuable. It's clear, we knew this as we started, that this is a pivotal moment for the insurance industry. The question is, will the industry, rise to the moment? I do, as we talk through today, just touching on these, how challenging, how complex they are, but embedded in this, and this is one of the concluding thoughts I want to have here, is that there is immense opportunity for the industry as well, for it to do what it does best, and probably hasn't, really promoted all that it knows about risk management, changing risk, how to avoid losses, but recover from them. So there's broad lessons here, but within this area, it's clear that there's going to be a lot more conversations, surrounding all of this. But I think today's conversation has done what I hoped it would do, is just begin to unpack some of these, sort of peel back these layers and begin to understand how difficult these are, how complex, but how important it is for every institution to be working hard and hiring the right talent to provide the skill sets, which Liberty has done and Marsh has as well. So thank you, Amy, Kelly, very much for this. Look forward to picking up the conversations in the year to come as well. Thank you very much. Bye.
Thank you.
Thanks for having us.